The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, so it is 2025. It's Friday, the 10th of January. Jeremy, Happy New Year and welcome back.
Hi, Gareth. Yeah, Happy New Year.
Good to see you again. And yeah, it was a pretty tricky 2024 for most people, but a lot of people are hoping that 2025 is going to be a bit easier or at least a bit different. So it'll be interesting to see how things play out. I thought this week, perhaps what we could do is I'll run through the way I think 2024 ended and 2025 is shaping up. And you can correct me where I'm wrong.
Yep.
I think the biggest reality facing most markets at the moment is that the US dollar still has the global reserve currency status. And what that means is that when Donald Trump goes out and says things which cause risk or uncertainty and certainly confusion, that means the markets worry, so the dollar goes up. And with the rising dollar, US inflation, all other things being equal, will be a bit lower. And everybody else is facing higher inflation because of that stronger dollar. And it's kind of in that context that markets are looking at all of the different geographic issues, you know, Europe's ongoing woes, China's got their own slowdown and their so far failing stimulus packages, and Japan's been still trying to reflate their economy finally after many decades of stagnation. So none of those things are easy to look at in isolation, but all of them, I think, have got this massive sort of overarching fear or issue, which is that whatever Donald Trump does, it tends to cause the dollar to strengthen and inflation in the rest of the world to rise. And that's the pressure that we're all battling against.
Yeah, I think that's a fair assessment. I mean, what we've certainly seen since the November election result has given rise, particularly in US markets, but global markets generally, of this concept of American exceptionalism, which implies a reset of this sort of established rules-based geopolitics. And that rise of American exceptionalism has resulted in this strengthening dollar. And that has consequences for everybody else. And one of the features of 2022, when we had very poor returns from both bond and equity markets, was a very strong dollar. During the course of 2022, the dollar rose by something like 20%. In the last few months, the dollar is up nearly 10% in a 3 or 4 month period. So we haven't quite got that level of hurt yet, but we're heading in that direction. And all this is ahead of the man actually becoming president and us finding out actually what he's going to do. Because part of the art of the deal is to disrupt your negotiating party ahead of time and then create chaos and then set high or perhaps unreasonable targets and then say, actually, wait, maybe we can do a deal here. Maybe we can make it so it's not quite so bad for you. And say, actually, Denmark, we can make this a lot easier than actually us just annexing Greenland if you do this and you do that. And obviously for me anyway, the big issue is going to be the ongoing relationship with China. And that will set the tone, I think, for where inflation expectations actually can land.
Well, it's going to be very interesting to see whether Xi Jinping gets a seat at the inauguration in 10 days' time.
Yeah, I think if he was going to be there, I think we'd probably know about it by now. So I suspect that's not going to happen.
But no, it is. It's a very tricky backdrop as we start the year. And obviously, most economies around the world, they're still battling those ongoing issues of demographic change with costs of looking after their elderly populations rising and tax incomes from the younger generations falling. And at the same time, we've got an ongoing pressure to move more towards renewable energy, which in itself will put energy prices up as we make that transition. So there are a lot of other headwinds around. And it's in that context that we've got Trump coming in. So, yeah, it's going to be a very, very exciting global macro backdrop for 2025. So lots to look forward to. And in terms of the UK, for quite a bit of last year, we'd been saying that the UK felt effectively a relatively stable and safe backwater. And if we had the dispersal trade and some of this huge US capital flowed elsewhere, then the UK was relatively safe and stable and certainly very cheap on a global market basis. And it feels like that's still sort of true, but a lot less attractive with such a fractured or at least worrying global backdrop?
Well, I mean, although the parliamentary position of the government that's only been in office for 6 months looks absolutely watertight, we all know that underneath that, there are issues around political stability, not least of which has been fomented by Mr. Musk on X. And I think it's all part and parcel of the Trump administration. What they're doing is sort of intervention in the UK political arena and in the German political arena and other European markets is to just destabilize things. I think it's sort of to soften up people ahead of some pretty tough negotiations. So in that context, I think the UK is relatively stable, but not as rock solid as perhaps we may have hoped or thought or believed 6, 9 months ago. And that's reflected itself in where sterling is. UK 10-year and 30-year bond yields have gone up and the currency has gone down relative to the dollar. So there's a lot of pressure on Rachel Reeves here now.
Yeah, absolutely. And it feels like the UK, as much as anybody, is a victim of this sort of Trump or MAGA disruption of the rest of the world in advance of Trump actually turning up. And if Elon Musk is one arm of that, then yeah, we've certainly seen our share of the global pressure.
The popular narrative is that it's inevitable that the Trump and Musk relationship will fracture at some point, and that might be true. But I suspect what we're witnessing at the moment is coordinated and deliberate.
Yeah, and we're bearing our share of that. So
yeah.
So we'll look forward to the macro developments in the rest of the year. And how about the UK? Have we had much stock-specific news coming out? I know there's been a lot of retail activity so far.
From what I've seen this week, although it's been relatively quiet on the corporate news scene in the UK, I think the main feature has been the trading updates from a number of consumer-facing retail stocks. So we've had M&S, Tesco, Sainsbury's Today, we've had Greggs, B&M, and a few other smaller ones. And the theme generally seems to be that the UK consumer in the run-up to Christmas, people did okay, people were spending. It wasn't a complete wipeout by any means, and particularly people like Next and M&S is doing particularly well. But they're all pointing to a more cautious outlook, which is understandable, and saying that they've got cost pressures increasing and the marginal cost of employment post the budget measures mean that they're more cautious going forward on profitability than they were before. So the larger UK retailers, in share price terms in the last few days, have been under pressure.
Which is in some ways a surprise, because everything I was seeing and hearing over Christmas was that it was a pretty soggy Christmas in terms of retail activity, but actually they've bucked that. A lot of them have done actually better than expected, but the outlook's more cautious. So it's a frustrating start to the year in terms of the retailers. And yeah, and I guess more generally, if investors are looking as to, where to put their capital, given all of the macro pressures that we talked about, it seems if I were back at an investment bank writing a sort of a research outlook or a compendium to start 2025, I'd probably be doing things like saying you want inflation or interest rate friendly stocks. So you might want to look at some banks. You want resilience. You want companies with good net cash positions or at least good cash flows. You're looking for growth, and whether that might come from tech stocks or people who are going to benefit from AI, or maybe look for stocks who've been oversold because of the worries about AI. And a number of stocks have really been hammered as investors have worried about the impact of AI, and some of that might be mistaken, or it might take longer to play through than investors have expected. So that there could be some bargains out there and sort of oversold stocks at risk from AI. And then there's always the argument about the sort of trading down names, companies who will benefit from ongoing consumer caution or consumer pressure. As people trade down, they're not spending on big ticket items. They're trading down to small luxuries rather than big ones. And there are a number of names over the years that have made that argument with varying degrees of success. How would you look at investing in this climate with the backdrop that we've got?
I'd agree with all that. I don't think I'd extend my portfolio to include any banks at the moment, not a reflection of what's going on in necessarily the UK domestic economy, just the global capital flows. I think the UK economy remains a relative safe haven. It's certainly cheap and unloved still. And we've read a lot about the fact that the UK economy, as with many other equity listing venues around the world, outside of the US for sure, are struggling to attract new entrants. And in the UK in particular, we're suffering from losing constituents through M&A activity in the main. And I've coined it the extinction trade as the way of looking at the UK market, because at the moment, with share buybacks, heightened levels of M&A activity and no effective new issuance, the UK listed stock market is on a trajectory for extinction. But I don't think the UK listed equity market is going to go extinct, because what happens when you get a threatened species is that you get a period of adaptation at some point along this path, or at least the rate of decline diminishes. So I think the way to look at the UK market is, as you say, you need to have a broadly spread portfolios. I don't know, say 10 names in the UK mid and small cap space that have resilient market positions with adaptable business models, with strong management teams that are trading below historical previous levels of valuation. And I think critically, significant discounts to where similarly traded companies might be valued in other markets, particularly the all-dominant US market. And I think if you've got a portfolio of 10 companies with those characteristics, the chances are over 2025, a good proportion of those could receive bids. Because if you're one of those companies and you genuinely have those characteristics, as things stand today, you'll get taken over, either by private equity looking to flip you back onto the market or a different market, or to grow you in a slightly different way using their private capital, or you're going to get taken over by a larger international peer. I mean, today we've seen Alliance Pharma, a relatively small UK player, taken out at a 40% premium. And I think we're going to see one or two a week of those things, at least for the first quarter of 2025. Until things change. And what things could change? Well, we could see a number of things, but it's to do with the relative valuation of the UK market. So one of the things that could change is the UK market could get revalued sharply upwards, which, of course, if you own 10 companies, you will benefit from that. So I think this sort of extinction trade, which does sound very negative, but I think actually holds some very asymmetric risk profile, in that the majority of scenarios you could paint for the world economy and for global financial markets over the next 12 months, the majority of those scenarios, you will either not lose money or you will make money.
Well, it doesn't sound too bad, and at least on a relative basis, you'll be hopefully protected from some of the worst outcomes. And if the takeovers or the market re-rating don't happen, that's probably because even worse things have happened elsewhere.
Well, exactly. When you're making an investment, the list of reasons not to do it is always 10 times longer than the risks to make the investment.
Exactly right. So yeah. Well, look, hopefully we'll help investors across the rest of the year decide which 10 stocks to put into that portfolio to benefit from that plan. And in the short term, though, what have we got coming up next week in terms of macro news that might sort of kickstart the rest of 2025?
Later today, we're going to get the US non-farm payrolls, which usually provide a bit of excitement, and employment both in the US and the UK is going to be more of a focus for attention at the moment. Next week, we've got inflation data both for the UK and the US. The UK inflation figures on Wednesday is likely to show UK inflation continue to run at about 2.6% on an annualized basis. US inflation is likely to fall slightly from last month's 2.7% to 2.3% is the expectation. So keep an eye on that one. Thursday, we get GDP data for the UK for November. The consensus is to see a marginal level of growth. So the annualized year-on-year figure is going to go to 1.5% from 1.3%. So if that's going to, I think, going to be closely looked at. And then on Friday, we're going to get a number of data points out of China. One of the things we haven't talked about today is the degree to which, while bond yields everywhere else in the world are going up at the moment, in China, they're going the other way, which, as people get more concerned about the state of the Chinese economy, that creates dislocation in financial markets when you get large differentials between interest rates across different currency zones, which are opening up at the moment.
Okay. So there's quite a bit of news next week, actually. So it'll be interesting to keep an eye on that. And yeah, look forward to the rest of 2025. And we'll catch up this time next week for the first weekly installment.
Okay, look forward to it.
Talk to you then.
Brought to you by Progressive Equity.